Today, I'm going to show you how claiming Social Security at 62 can enable a decade of zero income taxes, capture over $20,000 in health insurance subsidies, and extract nearly $150,000 from your IRA completely tax-free. I'm going to demonstrate this through a scenario with real numbers and a real couple who need $85,000 a year to live on and maintain their quality of life. And in the process, I'm going to reveal the one formula that makes this all possible. So let me introduce you to Tom and Susan. They're both 62 years old, married, living in Texas, and they're retired. Now, Texas is important because for the sake of this example, it's a no income tax state, which makes this example clean and easy. Here's what they have. Their combined Social Security benefit at age 62, if their claim early, is $36,000 per year. They have a pre-tax IRA worth $750,000. They have a taxable brokerage account with $250,000. And their cost basis in that account is 75%, which means 25% of it is gains or profit. And then they also have a $250,000 Roth IRA. Now, their annual spending need is $85,000 a year with no other income sources other than Social Security. And here's what Tom and Susan want to accomplish. They want to first qualify for health insurance subsidies before Medicare, and they want a tax-efficient withdrawal strategy that gives them increased spending capacity while they're young and healthy, but also preserves their wealth towards the end of their life. Now, I told Tom and Susan that it was best to think of their withdrawal strategy in distinct phases. The first phase would be the years before Medicare, but after they are retired. And so Tom and Susan both retired at 62. So the first phase of their income and withdrawal plan would account for the years between 62 and 65, right, before they end up on Medicare. And so here's exactly what Tom and Susan are going to do each year during that phase. They're going to take $36,000 in income from Social Security. They're going to withdraw $49,000 from their taxable brokerage account, and they're going to pull $12,000 from their pre-tax IRA. Now that's $97,000 total in withdrawals. Now I said earlier they only need $85,000, so hold that thought. I'm going to explain the extra $12,000 delta in just a minute. But here's what matters for taxes. Their taxable account withdrawal is $49,000, but they have a 75% cost basis in that account, which means that 75% of every dollar they withdraw is their original investment, which is money that's already been taxed. And so only the 25% growth is taxable, and that's what you see here on the screen. So out of the $49,000 withdrawn, $36,750 is basis, that is not taxable income, and only $12,250 counts as taxable capital gains. Now here's where things get interesting. Let me show you what their tax calculation actually looks like. So their taxable income sources are the following. A portion of their Social Security, and I'll explain how we arrive at this number in a bit in this video, but that portion is $5,125 that is taxable. Their capital gains from the brokerage accounts are $12,250, which is the taxable portion. And then their pre-tax IRA withdrawals $12,000, which the entirety of which is taxable. That gives them a total taxable income of $29,375. Now, the standard deduction in 2026 is $32,200 for a married couple. And so using this withdrawal strategy, they end up paying $0 in taxes while producing $97,000 in income. Now, here's where this gets really interesting, which is the next layer. Let's talk about their health insurance. For ACA subsidy purposes, their modified adjusted gross income is $60,250. I'll explain later how we calculated that, but at that income level, they qualify for a $6,744 annual subsidy on their health insurance. Over 3 years, from 62 to 65, that ends up being $20,000 roughly in health insurance subsidies handed to them by the government. And then remember that extra $12,000 they pulled from that IRA? Well, they only needed $85,000 to live on, but they created $97,000 in income. They can either Roth convert that $12,000 at no cost, or they can spend it to increase their quality of life. And what they've accomplished is getting $12,000 out of their pre-tax IRA at zero cost, which is essentially a free conversion. In over 3 years, that's $36,000 repositioned from pre-tax to after-tax accounts, which saves them a modest $4,000 or $5,000 in future taxes, depending on what rate they might end up in the future. So that was phase one of Tom and Susan's withdrawal strategy. But now let's jump to the second phase, which would be from ages 65 through 72. So that's from when they start Medicare through when their RMDs would kick in. At that point, they're on Medicare, so ACA subsidy game is over. They're not trying to stay under certain modified adjusted gross income cliffs in order to qualify. But watch what happens to their tax bill in this second phase. So they're still going to be ending up with their $36,000 in Social Security. And I should add really quickly that we're just assuming the present value of all these things. Yes, their Social Security benefit would increase. due to COLA or cost of living or inflation. So would their withdrawals, but so too would the tax brackets, the tax cliffs, the modified adjusted gross income cliffs. So for the purpose of this video, we're just assuming a present value of all these dollars, meaning today's dollars. So they're still taking their $36,000 in Social Security. Now they're going to withdraw $16,000 from their pre-tax IRA. So they're increasing that slightly, and they're going to reduce how much they take out of that taxable account and pull $33,000 from that after-tax brokerage account. And that gives them their $85,000 total to cover all their spending. And here is the tax calculation. Out of the $33,000 from their after-tax brokerage account, 75% again is basis. So that's $24,750. It doesn't count as income. The remainder, which is $8,250, counts as taxable capital gains. So their taxable income sources are a portion of Social Security, still $5125, their pre-tax IRA withdrawal of $16,000, and their capital gains of $8,250. Totals up to $29,375. Again, the standard deduction, $32,200, which means, again, they end up with zero taxable income and they pay zero federal taxes. Now, they're going to do this every year from age 65 to 72, 7 consecutive years where they pull $16,000 per year from their pre-tax IRA at no tax cost. So we add this all up. From ages 62 to 65, they extracted $36,000 from their pre-tax accounts. From ages 65 to 72, they extracted another $112,000 from their pre-tax accounts. That's a total of $150,000 roughly pulled from their IRAs at zero federal taxes over those 10 years. When required minimum distributions hit at age 73, those RMDs will be smaller. They've done some proactive withdrawals and tax planning to mitigate that. Now, they've systematically reduced the size of that future tax liability. And notice they haven't touched a single dollar of their Roth account, right? That small year-by-year Roth conversion they did in the first few years, which they could, again, repeat in that second phase of withdrawals if they wanted to, takes the Roth account balance from $250K to nearly $300,000. And that money continues to grow completely tax-free for emergencies or legacy purposes. And so at this point, you're probably watching this and you're thinking, what's the catch? There is no catch, really. This is just understanding one formula that most people overlook. So the question is, what is that formula and how does it make this all possible? How are they living on $85,000 a year, pulling money from taxable accounts and IRAs, and somehow only $5,125 of their Social Security is getting taxed? The answer is a formula called the combined income formula, which is buried in the tax code. This formula determines how much of your Social Security benefit becomes taxable income. So here's how it works. Combined income is equal to 50% of your Social Security benefit, plus all your other taxable income, plus any tax-exempt interest that you might have. Once you calculate that combined income number, here's what happens for married couples filing jointly. If your combined income is under $32,000, then 0% of your Social Security is considered taxable. If your combined income is between $32,000 and $44,000, then up to 50% of your Social Security becomes taxable. And if your combined income is over $44,000, then up to 85% of your Social Security becomes taxable. And here's what most people get wrong about this. They think these are cliffs. They think that if you cross $32,000 by even $1, suddenly 50% of all of your Social Security gets taxed. That's not exactly how it works. It's a graduated system. So for every dollar of combined income you have over $32,000, only 50 cents of your Social Security becomes taxable until you either hit the 50% cap or you cross into the next bracket when you go above $44,000 in combined income. And this is critical to understand because it means you have some room to optimize. So let me show you exactly how we use this for Tom and Susan in both strategies. So from ages 62 to 65, here is Tom and Susan's combined income calculation. We take 50% of their $36,000 Social Security benefit. So that's $18,000. We add the $12,250 in capital gains from their taxable account. And then we add the $12,000 IRA withdrawal. So their combined income is $42,250. We're $10,250 over that $32,000 threshold. And since it's graduated, we take that $10,250 and multiply it by 50%, which means that only $5,125 of their Social Security becomes taxable income, not the full $18,000 that 50% of their total benefit would be. So their taxable income is $5,125 from Social Security, plus $12,250 from capital gains, plus $12,000 from their IRA. And as I said earlier, that equals $29,375, which is under the $32,200 standard deduction, again, resulting in zero tax. Now let's look at their second phase, which is ages 65 through 72. their combined income calculation looks very similar. We take 50% of their $36,000 Social Security benefit, again, $18,000. We add the $16,000 IRA withdrawal, and then we add $8,250 in capital gains. Their combined income ends up being $42,250. So basically the same number, just shuffled differently. Same math as before. We're $10,250 over the threshold. So that means $5,125 of their Social Security becomes taxable. And in this scenario, again, they end up with $29,375 of taxable income, which remains under the standard deduction and results in zero tax. Now, here's a critical bonus insight. Roth withdrawals don't count in the combined income formula at all. They're completely invisible. And so that's why in some strategies, particularly if you're trying to qualify for ACA subsidies before Medicare, people without high cost basis after-tax accounts may use Roth withdrawals if they have Roth funds in that phase. But in Tom and Susan's case, because they have that high cost basis taxable account, we can preserve their Roth account and we're still getting the same zero tax result while also shrinking our pre-tax IRA and qualifying for healthcare subsidies. And so with the strategy that we just went over in this video, Tom and Susan capture $20,000, $20,000 plus in ACA subsidies. They save close to $24,000, $25,000 in federal taxes. It's a conservative amount, and ending up in a total benefit of almost $45,000. On top of that, they end up with close to $300,000 in Roth money without even accounting for market growth. And that money can continue to grow completely tax-free for future needs or for them to leave as a legacy. Plus, they've withdrawn nearly $150,000 from their pre-tax IRA, which means potentially smaller required minimum distributions, potentially lower tax brackets later in retirement, and potentially less risk of triggering Medicare IRMA surcharges down the road. Now, this type of strategy, claiming Social Security early and then executing a strategic tax plan, makes sense if you value having more money and flexibility earlier in retirement. When you're younger, you're healthier, you're more active, versus maximizing your total lifetime Social Security dollars on paper and hoping that you live long enough for that to pay off. This strategy isn't about squeezing every last Social Security dollar out of the system. This is about maximizing your after-tax wealth and maintaining maximum financial control through your retirement. Now, look, you might be sitting here and thinking, okay, Eric, I get it. I understand the combined income formula. I see how Tom and Susan engineered zero taxes. What about my situation? What if my account balances are different? What if I'm single? What if I have pensions? How do I actually model this for myself? What do I think about IRMA and other things like that? How do Roth conversions fit in other years? And you're right, your situation will have its own unique variables. It's exactly why we built a systematic process to take clients through this. If you want to see how we help clients build a complete tax-efficient retirement income plan tailored to their specific numbers, integrating Social Security timing, withdrawal sequencing, healthcare costs, and tax optimization into one cohesive strategy, you can learn more for free by clicking the link in the description below this video or scanning the QR code that's going to flash on your screen right now. It'll take you to another free video just like this that'll walk you through that system. Thank you, as always, for your time and attention. See you in the next video.